Hey guys, so in this lesson we'll be covering risk management and also covering the topic correlation. So what is risk management? So there's various ways of avoiding risk when it comes to the market, right? At the end of the day, a good trader is a very good risk manager, right? Because this is the one concept that people get wrong. When you hear people telling you, 90% of traders lose money, it's because of risk management, period, okay? Because with risk management, specifically trading Forex, you're using leverage, and people can leverage up so much that they're risking way more than they can actually afford to risk, okay? So risk management, let's talk about this a little bit, okay? I'm not gonna jump on the charts in this lesson, so we're just gonna talk, okay? So risk management, risking only 1% of your account size, okay? Write this down, risk 1% of your account size. So let me talk about this a little bit, okay? Because this is one way of avoiding risk. This is one of the main ways of avoiding risk, okay? By risking just 1% of your account size. If you're risking only 1% of your account size, it will take very, very, very long time, many trades for you to actually blow your account, okay? Because by risking just 1%, guess what? It's just 1%. If you don't know what you're doing, and you go through a big drawdown, it's just 1% by 1% by 1%, okay? It will slowly move. Your account will slowly decrease in value, okay? If you're risking 5% or max leverage, if you use max leverage and you risk as much as you can, which that's what people do, okay? Specifically newbies, and that's how they blow their account, by risking maximum by using leverage. Okay, so you'll be risking 5% a trade or 10% a trade, depending on how much leverage you use. But if you're risking 5% per trade, so instead of going down by 1%, you'll be jumping, literally jumping. Your account will be decreasing so fast that you will blow it within a matter of trades. Okay, in a month you can blow your trading account, literally, by risking 5%. If you do not know what you're doing, that's the most important thing, okay? So majority of you guys are newbies, okay? Maybe you've already been trading for a while as well, okay? But what I have been doing over the years is literally following this principle to the T, okay? So by risking 1%, again, it's extremely important because you're eliminating so much risk. You're eliminating the risk that is you, okay? Because face it, you have to reach consistency, okay? And until you reach consistency, there's the learning gap, okay? And when there's a learning gap, guess what? There's gonna be lessons to learn. My job here is to show you exactly how I trade, exactly how I apply my strategies, exactly how I manage, okay? So your learning curve is jumping, literally, by me putting this knowledge into your head, through these videos, through this masterclass. But there's still gonna be a learning curve. Know that, you're still gonna have to hustle and work your ass off, because there's a lot to learn. And once you reach consistency, okay, then at that point you could increase your risk if you wanted to. Many people choose not to. I never did, okay? I actually decreased my risk as my account grew and grew because I used a concept called capital partitioning. So I was using leverage, okay? Trading, think of this concept, capital partitioning is, as an example, something where you use leverage to your advantage. Not in a way where you use leverage to risk as much as you can. You use leverage for risk management purposes, and that's something, again, people don't do, okay? So how can you use leverage for risk management purposes? So we already talked about one way is by risking only 1%. Extremely important, okay? And like I said, once you hit consistency and you know what you're doing, okay? And what I mean by reaching consistency, meaning that you're consistent for 6 months minimum, a year even better, okay? So once you hit consistency and you're confident in your abilities, you know what you're doing, you're making consistent profit, at that point you may choose to risk more if you want. 2%, I would recommend just jumping in small 1% gaps, 2%, 3%, and higher if you wanted to, but again, many people don't, they just stay at 1%. Capital partitioning is a little bit different. You're still using the same kind of principle where you're risking 1% of your account size, but by using leverage, you don't have to keep your entire account in your trading trading account. You don't have to keep all your cash in your trading account. You can keep a small portion of it, okay? As an example, you can use 50% of your capital, such as, let's give an example. Let's say you have $100,000 to trade with, okay? Instead of keeping $100,000 in your trading account, you can use capital partitioning and keep $50,000 in your trading account, but risking 1% of the 100,000. Okay, so you're risking still $1,000 a trade instead of $500 a trade. Okay, but there's only half of your capital in your trading account. Okay, so you see where I'm getting at? You have less to risk because the other 50 grand, that other 50% is just chilling in your trading account. Okay, and later in MasterClass and add-on courses, I'm going to be talking about different concepts as well, such as equities and cryptocurrency and portfolio management. Okay, and that's where you can fully utilize the other 50% as an example. That's just kind of chilling on the sidelines in your checking account. Okay, but capital partitioning, Google it a little bit more, you know, because it is extremely important when it comes to risk management. You know, this is more in regards to broker risk. Okay, we had a situation a few years ago when the Swiss pairs, if you look at the charts and you look at the Swiss pairs and you zoom out, okay, for the last 5 years or so, and you zoom out and you look at what happened, and specifically if you look at Euro Swiss, okay, go look at the currency pair Euro Swiss, and you notice there's a massive drop. And I remember I was sitting on the charts during that time, and it was midnight in Vancouver, and it was actually a little bit past midnight, and I'm trading, I'm watching the London session. I was actually waiting for a few setups that day, and I'm just chilling. And all of a sudden the market started going crazy. It started dropping so fast that I didn't know what the hell was going on. I thought there was a nuclear bomb that went off somewhere, you know, because that's how violent that drop was. And that was something that the Swiss government decided to remove the peg, the agreement that they had with the euro. Okay, and you can research just a little bit more, that event. And again, it happened a few years ago regarding Swiss and euro. And when that happened, all of a sudden, people lost their accounts, everything they had in their accounts, because they were on the wrong side of that specific Swiss position that they were in. Okay, and because they were on the wrong side of that specific Swiss position, the market fell so fast that they lost it all. Okay, some brokers even went bankrupt because of that. And it was a huge event. And from that on, I'm grateful that I didn't have any Swiss positions. Some people that I know, they were on the right side and they made double their account size with that specific event. But you don't want to depend on that. You want to make money by reaching consistency, not by a fluke event like that, you know, because that's a very risky event. To prevent that risk, okay, that's where capital partition comes in. It's something that is not really in your hands, but by using capital partition, you can avoid the risk that's in somebody else's hands. You know, like the Swiss government removing that peg, or a country going into war that can cause a massive move in the market as well, you know, or a global recession, or any recession. You know, there's also going to be a potentially massive move in the market, you know. So instead of risking everything you get, you can risk a small portion, use leverage, okay, so that you're risking the whole amount, but just keep a small portion of your of capital in your account. Okay, Google the concept to learn more about it, but that's another way of risk management. So we covered risk management by using just 1%. That's specifically for you. Okay, you have to do that. Well, I don't want to say you have to. That's what I do. Okay, that's what I did. I only risk 1% of my account size, and that's to avoid my risk. Okay, because guess what? I didn't know it all. I still don't know it all. I learn a lot. I'm still learning all the time, and you will too. Okay, and by risking 1%, you're avoiding your risk, the risk that you can have by placing the wrong trade or not applying the strategies properly and such. Okay, by capital partitioning, another way of risk management, you're eliminating the risk, you're managing the risk that can be caused by somebody else, by an external factor of some sorts. Okay, so capital partitioning, you just keep a portion of your account. It can be 50, it can be 40, it can be 30, it can be 70%, whatever you want. Okay, majority of people start with 50%, and then they capital partition further if they want to. Okay, so that's another way of using risk management. The third way of using risk management is, again, it's related to trading itself, okay? It's related to correlation. And let me talk a little bit about correlation risk. Correlation risk is sometimes you're going to see when you're making a watch list, sometimes there's going to be currencies, okay, that have setups everywhere, such as maybe an Aussie pair. Maybe there was a news announcement on Aussie in relation to Australian dollar, okay, to that economy. There might have been a news announcement that made the market move in a specific direction, okay, the previous day. And now that you're making a watch list, all of a sudden you see that every single Aussie pair has an opportunity. On every single Aussie pair, you can apply the strategy, okay? Or every single CAD pair, or every single dollar pair, or every single pound pair, you know? So correlation risk, it means that because it's an Aussie pair, okay? So it doesn't matter if it's Aussie dollar, or Aussie CAD, or Aussie Swiss, okay? Or pound Aussie. Because it's an Aussie pair, you don't want to expose yourself to the Australian dollar too much. So that's correlation risk. Correlation risk is you exposing yourself to a specific currency too much, okay? So this is where you literally look at the strategies, look at the pairs, okay? So look at the correlation. So if it's all Aussie pairs that are showing you those opportunities, then you look at all those Aussie pairs. You see how the strategies apply, and then you do the next step. Which one of those pairs has the best setup overall? And this is where you use your discretion, okay, to figure that out. You simply look at the strategies, how it's applying, and the one that you believe is the perfect one, the best one out of the group, that's the one you focus on, okay? And you take one trade. Therefore, you're risking only 1% on that specific currency, okay? Just 1%. However, if you choose to take 2 trades, that's okay, I do that too. There might be 2 trades that I love so much, so I decided to take 2 trades on that specific currency. Maybe even 3 if they're all amazing, like perfection. I might even choose to do 3 pairs on that same currency, okay? So in a sense, I'm risking 3% on a very similar movement. I'm risking 3% in saying that the Australian dollar is going to go up, as an example, okay? Now that's quite a bit of a risk. So it's very rare that I ever do that. You know, I might only do that a couple times in a year, okay? But typically I just resort back to just one trade, okay? When it comes to correlation risk, I look at them all, I pick the ones that I believe are the best ones, and then I just wait for the opportunity on the best one, okay? And just take that one, or maybe 2, okay? If they're, like I said, they're both amazing. Therefore, I'm only risking 1% or maybe 2% on that one currency, okay? So this is correlation risk. Again, you can research that a little bit more, but I think I explained this well enough, okay? You'll get the concept the more you'll kind of listen to this video, and the more you trade, you'll know what I'm talking about. You know, this all comes through experience. So again, 3 different risk management ways. The next management ways, well, that's having a plan, okay? And trading your plan. That's you minimizing risk, is creating a plan that is good, that works. And that's my job. That's what I'm teaching you guys. I'm teaching you my plan. You know, it's what works for me, my strategies, and how to implement that. Okay, so you don't have to really focus on that because I'm going to teach you. But you have to know those different ways to manage risk. Okay, so to quickly recap, the method number 1 is risk only 1% of your account size. Don't use leverage to risk everything, to risk maximum, to risk 5%, 10% per trade. Risk just 1%, okay? And go from there. Once you hit consistency and you've been consistent for 6 months or a year or longer, you can choose to do whatever you want, okay? Risk 2% if you want. The next way to manage risk is capital partition. So only keep a portion of your cash in that trading account, but risk the whole 1%. So if you have 100,000 grand, like 100 grand, you would only keep 50 grand in your trading account, 50 grand in your checking account, but risk 1% based on that 100 grand, you know, so your 1% risk would be $1,000, okay? But you're using leverage for that. And this is you using leverage in your benefit. It's using leverage for risk management purposes, which is a great option as well, okay? And the third option that we looked at is correlation risk, something that happens again all the time in the market. You will see it, specifically if there's a news announcement on that specific country in that specific currency, whether it's Aussie, CAD, dollar, pound, euro, whatever, you know, you're going to notice that there might be multiple opportunities that day on that specific currency. Okay, so correlation risk is avoiding taking all of them. It's picking the best ones, whatever you think fits the strategies the best, whatever you think is the best opportunity, and taking that one trade, maybe those two trades, maybe three if they're like all amazing, but understand you take three, you're risking 3% on the same move, you know? So that is correlation risk. I hope you guys understand this, review it as many times as you have to, even Google it if you want to learn about the concepts a little bit more, okay? But they are all really important. I use them all, I pretty much always have, okay? And it's pretty much you preventing what you want to do. You want to become a professional risk management manager, you know, not a professional trader, professional risk manager. You know, if you think that in your head that you're a professional risk management, you're going to approach the market a little bit differently. Your main purpose is to preserve your capital, keep your cash back. You don't want to blow your entire account like the majority of the traders. That's what they do. They blow their entire account. You don't want to do that. Why would you want to do that, right? So using risk management and thinking in those kind of ways as a professional risk manager, you're trying to stop yourself or stop any other outside sources from blowing your trading account, okay? Instead of literally focusing on risking as much as you can, okay? In this way, you're just risking what you have to, okay? To preserve your cash bubble, okay? So with that said, again, I hope it all makes sense, and that's it for this lesson, and I'll see you guys in the next one.